Strong start for the Indian markets. Benchmark indices extend Friday's gain led by financials. The Nifty bank hits yet another record high as the RBI policy-fueled rally continues. The broader market outperforms key indices.
SEBI approves MCX launch of electricity derivatives. Stock surges close to around 5% as an opportunity opens up to capture the share in what is one of the largest derivative segments globally.
The SEBI's nod to MCX to launch electricity derivatives also boosts IEX, which is the largest player in the electricity spot market, and has an agreement with MCX for underlying prices. An agreement with the NSE is also likely.
Tata Motors lays out its growth outlook ahead of its analyst meet, targets 600 basis point market share gain in commercial vehicles by 2027, also eyes market share gain of over 300 basis points in the passenger vehicle segment by 2027.
MGL too is up nearly 4% as it guides for compounded volume growth of over 10% over the next 2 to 3 years. The company says it will prioritize volume growth over margins.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and it's a good start to the week with the Nifty trading well in the green. But in the next half hour, Rod, we've got two managements on the show. So Mangalam, let's get straight to the action.
Let's get straight to the action. It's a very good day of trade. Your portfolios would be looking good and nearly 2,000 stocks in the green for just about 500 in the red. The first one we're talking about is Zagel Prepaid. Announced a couple of new acquisitions set to acquire Dice Enterprises for about 123 crores, while they will also acquire GreenEdge Enterprises for about 27 crores. Raj P. Narayanan, who's the founder and executive chairman of the company, joins in to discuss these acquisitions. Thanks a lot, Raj, for joining in. Congratulations on these acquisitions. You had given us a hint. Avinash had joined us post the fourth quarter numbers and said that they will close in on two acquisitions very soon. And so it has happened, two acquisitions very soon. Though what the street wants to know is the basis for arriving at these valuations and the scale that this can get to you. Why do I say that? Because, the golf business that you've acquired, GreenEdge, has revenues of about 20 crores in FY24. Wonder what the FY25 number for that is. And you've paid about 27 crores for this. And Dice, which is in low single-digit crores when it comes to revenues, you've paid 123 crores. So we wanted to understand the rationale, the scalability, the opportunities here.
Yeah, great. Thank you. Thank you so much, Mangalam. I'll go first with GreenEdge. It's a very small, beautiful company which is run by golfers, with international experience. Okay, they started the company a few years back, and this year revenue, which is FY25, okay, March 25, is about 36 crores and about 4 crores of EBITDA is what they have done. And it is expected to do roughly about 55 to 60 crores in the coming year. And we are very hopeful that we would be able to, with Zagel's distribution power, we would be able to go ahead and take it to about 100 crores in next couple of years with about, 13 to 15% EBITDA margin. It's a great company. It's a place where, where we had not been there. They have about 7 banks and they are in the loyalty space. And within the loyalty, they have got a huge, leg up because they do golf rewards. Okay, so redemption of golf rewards is a highly accretive thing. And in my opinion, it's in the coming years, it might actually turn out, a great company to service international, banks as well. So for us, it's a very strategic acquisition, improves our overall flow. This is one segment, which is the bank loyalty space, which we were not there. And now with this, we get the entry. Already Zagel sales, distribution, marketing, everything is in place. So for us, whatever growth comes would be accretive. So this is what, is about GreenEdge. About Dice, I'll tell you, it's a beautiful company, fantastic. This year, they have done about 12.93 crores. And next year, probably they would be able to touch about 21 crores. Okay, pure SaaS revenues, they have not done any payments, which comes in there. So with Zagel's payment rails coming in as, next to the software which they have built, it would be a hugely accretive game for us. For us, it actually signifies a deeper play in the enterprise software payment segment, which is the highest premium segment overall in the world today. If you were to ask after the quick commerce multiples. Okay, so that's a great positive for us. Our suite of Zoyer would also get completed. We already have accounts payable rails, and we have doing exceedingly well in Brome. This will add procure to pay, to the overall system for us. Second,
Okay.
yeah,
All right. Sir, appreciate you giving us some guidance with regard to Green Edge, which is pretty clear out there from this revenue number of around 20 crores approximately. You're seeing it will go to around 55 to 60 crores and then head towards our 100 crores. We got that. On the other one, it's a little interesting because for that business, you're spending 120 crores. And as you said, the revenues were just, I think, around, high single digit, I think close to around 10 crores for FY25. Tell us the rationale about this valuation difference and how you highlighted with regard to Green Edge. Where is this number headed from around 10 crores? Where does it go to and what are the margins?
So, the last year they did about, which is March 25, they did about 12.93 crores.
Okay.
Go up to about 21, 22 crores. Huge synergies is what we have. Combined savings will be over 15, 16 crores. So that is something which you have to add to it because, the same tech talent, which is extremely difficult to get in this space. We are getting a fantastic team. Both the founders are phenomenal guys. Along with them, a team which has been trained in this kind of business, which is very, very difficult to get is what, we are getting. This also, will complete our suite, and would be a huge springboard for us to, launch in the US. Those advantages are the ones which we saw, and we are looking at a little bit long term. They will turn a bit positive, this year, and post that, it will be all accretive. So we have looked at as to, for our growth chart, and as we have already given you that guidance that in next 5 to 7 years we want to be $1 billion revenue company. So this company will help us launch, our international operations, which were slated to, go on board in FY26, would go in and about that. And with this, we are very hopeful that we will be able to log in, a very decent number of clients in the international market. So the other thing which I also want to tell you is that currently, they were also a competition to us. Okay, so a lot of deals, the pricing was like little bit up and there because they would also compete, we would also compete. With this acquisition, we will become the largest player in the spend management market, and I don't think there would be anybody nearby. Okay, so this gives us that pricing power ability to up the pricing a little bit is what Nigel is one of the reasons that we have looked at the company. And overall, if you see, their AI stack, if you look at it, their build is fantastic. Okay, so they are one of the early starters, and in fact, their payable agent, will be released soon.
Right.
Our 3,400 clients, we will be able to take their offerings, to those clients, and which will be accretive for us. Okay, today they.
So, net, this is accretive for you, both the golf business and this business. This, of course, completes your overall stack for Zoyer, which you intend to take it to 50% of your revenues, which is close to 40% of your revenues, grows faster. All of that, we take the point. What the street really wants to know now is that because DICE has such an exciting prospect, would they want skin in the game? So this 123 crore that you're paying, along with the 27 crore that you're paying to Green Edge, will that be paid via stock? What's your cash situation right now?
Yeah, so we have enough cash because there is also another large deal which is in the pipeline, is stuck for legal reasons. There have been, some notices, etc., which they have got. So we are, trying to solve that. Here in this DICE case, it is going to be about 30%, cash and rest will be stock. In the case of Green Edge, it would be reverse, which is 70% cash and 30%, stock, depending on, how the overall team aligns and, together we work together towards, becoming a real, very decent size giant in terms of the spend management market is how we have.
Okay.
Incentives are also aligned similarly.
And the next big deal you're talking about, how big is that and by when are we likely to hear on this?
It's stuck. In fact, to be very honest, I wanted to come to your studio and dance along with you guys. It was my, is what, I had told both of you. So we're just waiting for those, glitches, to get over. And the moment those glitches are over, we should be out there, hopefully.
All right, sir, we're always up for a dance. That's post-market hours on Friday. But we invite you to the studio and talk about the next big deal that you're doing. All the best. Thanks for detailing both these two acquisitions. And we look forward to having you on the show and talk about the next big deal. Appreciate you joining in here on CNBC-TV18. Well, time to slip into a short break as promised. Today we have two big managers with us. So that was Zagel. And next up, we'll be hearing from Mr. Manish, Managing Director and CEO of Kalpataru Projects International. Stay tuned. They won a massive project over the weekend. Welcome back. As promised, we're going to be getting straight to the management of Kalpataru Projects. The stock is buzzing. Remember, they won orders of around 3,800 crore rupees. Mr. Manish Munut, the Managing Director and CEO of Kalpataru Projects, comes into the studio. Hi, Manish. Thanks a lot for coming down and congratulations on this large order. Well, give us a few details with regard to this project. What kind of margins are you looking at? Explain to us the two segments as well as geographically, how is it split, the 3,800 crores?
Good morning, Nigel. And fabulous studio. I've come here after a long time.
Come more often.
Yeah, I'll do that for sure.
That you'll have to win a lot more orders.
We will do that. So the orders which we declared today morning are approximately of 3,800 crores. Right. It involves a very large order with a large real estate developer based in southern India. The order pertains to northern India of 12 million square feet plus.
Got it.
This is a second order of 10 million square feet plus, which we have got in the last 18 months. Typically, historically, we used to do orders of much lower value when we were, two different entities. But today, with such high volume available, we're among the top 2-3 in the country doing 10 million square feet plus.
Yeah.
So out of the orders, one significant order is that there are two more orders into building and factories, one in Western India, one more in Northern India. Mm-hmm. And there are some orders in the transmission space.
So what is the margin typically of this and how long is the execution period?
So typically the margins for all of them range in the range of 9 to 11% at EBITDA level, right? From execution perspective, majority of this are 2 to 3 years, and some of the buildings in this large order go for closer to 4 years.
And since we started by inviting you more often because we expect you to win a lot more orders, just talk about that. What's your overall order inflow guidance for this year? And when at the start of the year you gave us that number, did it include this 3,800 crores or this is over and above what you had spoken about?
No, okay. So to be very frank, it included the 3,800 crores. We had no clue that we would get it so sooner.
Got it.
So if you look at us, right, in the last 3 years, our order book has doubled. We were at 30,000 crores. Now we're at around 65,000 crores at the year end. Okay. For the current year, we've guided for orders in the range of 28 to 30,000 crores. While we speak, we already have got in excess of 6,000 crores in the first 2 months.
Exactly.
I do not see much challenge in making sure that we get this 28 to 30,000 crores. For us, more important is that profitable growth and working with people who we believe are the people we want to sustain long-term relationships and making sure we can deliver this kind of order in the defined time frame.
Okay, all right. So let's focus on a couple of aspects then, since you mentioned that profitability is something that you're focusing on. I understand that you're looking at your revenue mix changing in such a way that your PBT will improve. Yes. So tell us, what is the mix you're looking at in terms of an ideal mix? And also, what is the PBT guidance you could guide us for?
Sure. So, Nigel, if you look at KPIL today, approximately 45% of our order book is international, 55% is domestic. So, one, we are looking at a well-diversified order book, both on domestic and international.
Yes.
Second, we are across 6 segments, right? But if you look at the last 18-odd months, we have been focused a lot more in transmission and B&F.
Yes.
Because you see a lot of opportunities coming in there. For us, it's very important to make sure that we deploy our resources where we get our maximum profitability. So that's why B&F and T&D in a big way. Okay. Now, margin improvements is happening across the board for 2 or 3 reasons. One, there is so much work. Second, there aren't many large-scale EPC contractors who are doing this kind of projects.
Yeah.
And third, our presence across 6 segments.
Yeah.
So with all of this, we're expecting closer to 50 basis points margin improvement in the current year in standalone. But on console, we're looking at closer to 100 basis point improvement in the current year.
And on PBT?
On PBT.
All right. And since you spoke about the merger and how, the consolidated entity has led to improvement in the order book, etc., what proportion of cost synergies have already been realized and how much more can come? Because you said that on a consolidated basis, your margin improvement would be a lot more.
Sure.
So that, I believe, underlines a lot of synergies there too.
I think cost synergies to a great extent has happened, right? Okay. It has happened not only in terms of, let's say, improving margins, but it has happened in terms of improving our design engineering skill set, getting that merged entity which becomes mechanical, electrical, civil, doing large-scale projects, all of that. So to a great extent, we have done that. But right now, the margin enhancement is because of the great order book. right? And continued focus on large-scale projects with repeated clients.
Okay, all right. Another focal point, that we look at is cash flows and working capital cycle as well. And you've pressed on that point as well. I think the working capital cycle days had improved in the last year.
Yes.
So for this year, what is the working capital cycle days? And since you'll have unlocked some value in some of your projects, also you'll raise money by the QIP, interest costs came down. Interest costs as a percentage of sales is something that you look at. So throw some light on working capital days as well as on interest costs as a percentage of business.
Sure, that's a brilliant question because that's very close to our heart, right? We manage balance sheets as Marwadis, like very close to our heart, right?
I'm a Marwadi here, so I understand
that's something very close to our heart. So for us, net working capital days always have been below 100. Forget that COVID year, right? So that's been a target on a standalone. We came down below 100. We are targeting closer to be 90 in the current year. On console, we are closer to 80 days.
Yeah.
I believe it should only come down. Right? Interest costs as a percentage of sales for the last 10 years have always been lower than 2%. And we are among the, I would say, the topmost in the industry when it comes to interest costs as a percentage, in terms of being the lowest.
Yeah.
Current year target is how do we reach closer to 1.75%, right? We're driving that. But as far as all of us are concerned, the focus is net working capital 90 to 100, interest cost below 2%. And we're going to drive that across the
As a percentage of standalone or console?
As a percentage of standalone, it would be that much. As a percentage of console, it will be much lower. Much lower.
So this 50 basis points margin improvement that you're talking about, one supposes that 25 basis points comes in from the improvement in your order book, and the other 25 basis points comes in from you reducing finance costs as a proportion.
I would say 40 and 10. Interest cost reduction, 10 basis points, right? Because a lot of it has already happened. QIP money came in into December and things have started. But a significant portion comes in from the new order book and focus on execution in a big way.
And because of the QIP funds, your net debt is down to sub 2,000 crores. You spoke about being Marwadi, and both of us will have to ask you this question. We pride ourselves on being net debt free as well at some point. What is your debt repayment plan here? And with the kind of order book that you have, with the kind of cash flows that you will generate, I'm sure you would look at deploying that into debt repayment as well.
So net debt at the year end was around 1,100 crores. Right, at a standalone level. At a console level, it was about 2,000 crores. The difference between standalone and console is primarily road boot assets and some investments in international. So step by step, road boot asset, one of them, we have already signed off a binding agreement. We're expecting approvals to come into Q2, which would mean a reduction of closer to 700 to 800 crores on totality basis. On a standalone, while it would go up the first 2 quarters, typical cycle of business, but it would gradually come down. Also important to know, in the last 3 years, we put in more than 1,000 crores in capex. We built a balance sheet because it was visible that there's so much opportunity coming in, and we've used cash to do that also. So where we are on net debt, I think 1,100, 1,500, whatever, considering growth, whatever comes in is there. Yeah. But a lot of it would come from non-core assets, whether it is on Indore real estate, which we sell off fully, whether it is on VEPL, which we have already signed a binding agreement, and you'll see a lot more money coming in from there.
And the execution, I missed that number. Revenues for this year, how much higher will they be in comparison to last year?
So we're targeting a minimum of 20% in terms of revenue growth, standalone and console. But given the kind of orders coming in now, we will target much more. Let's wait for Q1 results and see that if we can do higher than 20%. So
26 to 28,000 crores was what you had targeted at the start of this year. You believe that you will stick to it, maybe perhaps the higher end of this range if things fall into place.
Yeah, I would say more closer to 28,000 crores.
Okay, since you've come down to our studios, we always press for big places, big occasions, big numbers. You have your order book at closer to 65, 66,000 crores. When do you get to 50,000 crores in revenues?
3 years from now, definitely. See, our biggest challenge today is not order book. It's not capex. It's not balance sheet. It's availability of labor.
Yeah.
Right? Because the biggest challenge the entire industry has is availability of labor. Yeah. So while we want to grow at 20%, we want to make sure we don't compromise on margins. We don't compromise on a commitment on delivery. And that's why growing at 20% is good. Targeting 50,000, definitely. We've come here, but maybe give us a window of 3 odd years and we should be there sooner than later.
All right, Manish, it's a pleasure having you in the studio. Thanks a lot for joining in. I believe I'm in good company every day with Mangalam. And now, as you said, the Marwadi trend as well. For me, being 14 years covering business news, my best friends actually from the Marwadi community. But thanks a lot for joining in.
Thank you very much.
And it's quite rare that Mangalam and me have to look up to someone, So we are feeling a little shorter, 2 6-footers, feeling a little shorter. Thanks a lot.
6'3". Thank you very much.
Thank you.
Okay, with that, I think we'll take a short break. And as we do that, we have some good news for all you viewers. We've started CNBC-TV18 Access. It's a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, a lot of market intelligence, and expert thought leadership as well. This membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, and a lot of master classes as well. What this brings you also is a curated set of lifestyle benefits designed for an immersive and enriching experience. It empowers members with premium business intelligence and unique benefits, the power of insight, the privilege of access, exclusivity, experiences, and influence. It's yours to claim. Become a member. Log on to cnbc-tv18.com/access/plans.
Welcome back. You're tuned into Chartbusters here on CNBC TV18. No worries, as you can see. I think we'll get that back up for you. All the headline indices trading well in the green. So it's a good start actually to trade. We had a couple of large trades that took place today as well. Suzlon, case in point, that stock as well has perked up. That's moved to the high point of the day as we speak. So it's been good times for the markets. Good start to the week. We'll wrap up on this edition of Chartbusters, but you stay with us because the Trading Hour team is waiting next.